hike. Peter Barnes is sitting down right now with Dallas Federal Reserve Bank President and CEO Robert Kaplan in a Fox Business exclusive. Peter, good morning to you.
Hey, good morning, Maria, and let's get right to Rob Kaplan on this question. You have a meeting coming up in December. You and your colleagues have been forecasting one more rate hike this year. Is the Fed going to raise rates in December?
I think, and I've been saying, I think we're at the point where I think we're ready to remove some amount of accommodation in the near future. I usually don't comment on individual meetings, but I've been saying for the last couple of months, I think we're ready to remove some amount of accommodation, and I still feel that way heading into December.
But because of the election, we have seen with the prospect of potential fiscal policy, stimulus, infrastructure spending, help for the economy to make it grow faster, the markets have seemed to already move before the Fed. I mean, right. The rates on the 10 years have jumped, I think, about 75 basis points since the election.
Yeah, this is what markets do. They're anticipating what might happen. Our job at the Fed is to assess conditions as they unfold, and I've been saying in my speeches for months that I think we need policies beyond monetary policy. We need infrastructure spending, other economic policy, structural reforms. So I think that is a good thing. We'll just have to assess these individual policies and see what's actually implemented. But I think if there are things that actually help improve the path of growth and improve employment, then I think it'll give us a little more operating room as we head into 2017.
And it would also potentially could affect the pace of rate increases going forward if we get a lot of stimulus. Right now, you and your colleagues are also, in your last set of economic projections, looking at 2 additional rate increases in 2017. Could that change depending on the policies that the Congress and the new president implement? Could you be rethinking gradual?
Sure. I've been saying gradual, patient, and yeah, as we see policies unfold, part of my job as a central banker is to take those policies into account and determine and analyze how they might be impacting economic growth. And so, yeah, part of the job is to have an open mind and be open to evolving conditions, and we will be doing that.
The latest economic numbers, the latest jobs report, 160,000 in November. We're seeing inflation edging up to your 2% target. Are all the pieces coming together then for getting going and moving on rates as far as you're concerned? What's your outlook?
We're making good progress on our dual mandate. As you mentioned, job growth has been, while there have been ups and downs in the data, the averages have been very consistent all year. 175,000, 180,000 jobs since the start of 2016 on average. And we're making slow progress on inflation. And so the concerning part is GDP growth has been sluggish. It's been sluggish since the Great Recession. There's some good reasons for that. One is the household sector has been deleveraged, but the other big reason, among others, is aging demographics. The workforce is aging, which is reducing participation. So that's still an issue that has to be dealt with in the months and years ahead, but it's going to take broader economic policy, I think, to help address that issue as well as other big secular headwinds.
You also, though, have to pay attention to what's going on with the dollar, and there's some speculation the dollar is hitting all-time highs. That makes the price of imported goods lower, keeps downward pressure on inflation. I know you're watching it, but could that change the outlook for rate hikes?
So we watch the dollar very closely, and in Texas we particularly watch it. We're the largest exporting state in the country, and so a stronger dollar creates a headwind for U.S. goods that we're trying to export. We're also aware that it can have global effects. So I was just in China. China's got dramatic overcapacity, high levels of debt, and they're worried about capital outflows. And we watch China carefully because of potential destabilizing impacts of a rapid increase in the dollar. And while we're central bank of the United States, you notice that the Chinese currency has been, while the dollar strength has been declining. And the issue for that is it creates potential for financial instability. So yeah, I'll be definitely watching that.
We are at an energy conference here at your Houston branch. The energy sector is so critical to the overall economy, and it's been just gotten slammed. Is the worst over for the energy sector from what you see here in the Dallas, in Texas? And where do you see oil? Where are you forecasting oil prices?
So our analysis of the Dallas Feds and our talks with our contacts suggests that we're heading toward balance, global supply-demand balance in the first half of 17. That means you're going to see prices firming, not rising dramatically, but firming. You're seeing rig count slowly increase. And yes, we think over the next few years, you're going to see a better tone to the energy business. That's because we're finally getting into balance in the global supply-demand picture.
Good news for consumers, but not the best yet for energy companies. But let me pull Maria in. Maria, do you have a question for Rob Kaplan?
Yes, thank you so much, Peter. And Mr. Kaplan, we're happy that you're with us this morning. We have been talking a lot about the economic proposals on the table. Obviously, President-elect Trump wants to roll back regulations. He wants to cut taxes. And his economic team believes that that can double growth from 2% to 4% in a short period of time. Do these proposals, in your mind, have merit and have potential to actually move the needle on economic growth?
So I'll be careful, and I'm careful as a central banker not to get too deep in individual proposals, but I would say we believe, and I believe, there needs to be broader economic proposals. Infrastructure spending is a good example. Structural reforms. I think we also have to be mindful, though, we've got a very high level of debt to GDP in the United States, and the present value of future unfunded entitlements is $46 trillion. So we've also got to keep that in mind. And in terms of longer-term growth, the path of the labor force, the aging demographic of the labor force, and needs to be taken into account, and the fact that we've got a relatively tight labor market. And I know there's disagreement on that, but we think much of the participation rate decline is demographics. So I'll be assessing these proposals. I think some of them could be helpful, some could actually be hurtful, and we'll just have to see how they unfold and not prejudge.
Yeah, because so there's a debate going on in terms of where we are right now. We had someone on the show a couple of weeks ago who said, look, I think we're in recession already because of what we see in wages, what we see in terms of growth right now. Yeah. What's your characterization of where we are in the economy right now?
I don't think we're in recession, and I don't see a recession coming even before this last period. And the reason is the consumer in the United States is strong. We spent 8 years with the consumer deleveraging. The consumer is over 70% of the economy. The consumer balance sheets, debt to income, is in pretty good shape. So no, GDP growth is sluggish by historical standards, but I don't see a recession. But I would like to see policies that will help address this demographic trend and the fact we see sluggish economic growth and sluggish demographics in all advanced economies.
Thank you, sir.